is a bad decision. Is this clear? Perpetuity. For example, I will not apply perpetuity. I know a particular year it is going to end. So what I will do, I will take 30 lakhs. It has to be, let us say for 20 years he is giving me this guarantee. That is giving 27,000. Okay. So now 27,000 I will take first month divided by what I should do? 1 plus interest rate. What is the interest rate? That I don't know. Yes or no? So that interest rate is actually per annum, no? This is per month, so I will divide it by 12. Is this clear? So first month I am going to get this. Okay. Second month 27,000 divided by 1 plus again I by 12, whatever value I get, whole power whole square. Like that each month the time value of money I will apply. Okay. For each month I will apply time value of money. I will see whether it will come out to be 30 lakhs or not. Okay. Like how you take these decisions in project investment also, you will take the same decisions. Okay. You understood this part? When I don't apply the present value concept, when I don't apply time value of money, okay, that those are called non-discounting methods, that is traditional methods. What do you do in traditional methods? In traditional methods, we say, I invest after 2 years, I'll get this 30 lakhs or not. That is what I'll see. But it is a wrong method. It is not right or wrong. In financing, nothing is right or wrong. There are advantages and disadvantages in this. Are you understanding? You go to any people who doesn't understand about business or finance, they will tell you, you go to them and tell, sir, I'll invest 20 lakhs. Okay, you invest 20 lakhs, I'll give back after 2 years 20 lakhs. They'll say, okay, he's anyway giving back 20 lakhs. Okay, if they don't have the understanding of time value of money. Okay, those are called traditional methods, non-discounting method. Okay, where discounting method, that means present value of money I am considering, those are called discounting methods. Okay, clear? There I will see all the present value of money. For me, time value of money is very, very important. Is this clear to you? In this, again, these are fixed cash flows or they are not fixed? They are fixed cash flows. Did you understand? When will I get the fixed cash flows? If I give somebody to a loan for fixed incomes, I'll get fixed cash flows. But do I get in every project fixed cash flows? No, I'll get varying cash flows. Sometimes I invest in a project, I may not get first 6 months, but after 6 months my cash flows keep coming, but in varying form, varying time it keeps coming. Once 20,000 first month I'll get, 40,000 second month I'll get, suddenly 10,000 I'll get. When season is in peaks, I'll get 1 lakh. Ice cream business, you see, season in peaks, I'll get 1 lakh. Again in rainy season, winter season, I don't get it. Are you understanding this one? All these I need to calculate. Did you understand this one? Clear? That is what we are going to do in this capital budget, the section 2 part. Clear? Understood? So, traditional non-discounting. There are 2 methods in traditional non-discounting. One, payback period. Payback period is simple. I just know, I told you, no. You give me 20 lakhs, after 2 years, I'll give you back 20 lakhs. That is called payback, period. Payback period I'm calculating here, 2 years or 3 years, it can be anything. Okay, next, accounting rate of return. Okay, accounting rate of return, IRR and ARR. ARR means what? Accounting rate of return. I invested this much, you give me in installments that 20 lakhs back. Again, here also I'm not considering time value of money. 20 lakhs I invested. First month you give me 1 lakh, second month you give me 3 lakhs, like that. Complete that 20 lakhs back. Did you understand? Clear? Time adjusted and discounted. Here time value of money is very important for me. What are those? NPV, net present value. You did it in your foundation. NPV, net present values, means all present values I will take net of them. That is what is called net present value. Easy. If you don't recollect, it's okay. We will do it again. Okay, they are very easy. Okay, next. Profitable index. This one you did not do in your foundation. The first time that you are going to do. Profitable index. Here also time value of money I will consider, and cash flows need not be constant. They can be changing. Okay, clear? Internal rate of return, IRR, internal rate of return. That means for all the cash flows, if I consider this much to the total, how much I am going to get in the returns. If I see all the cash flows that I got, I put it in one chunk, how much money that I got in return. That I will see is called internal rate of return. If you don't recollect, it's okay, we will do it. Okay. See, watch which all you can recollect, which you cannot recollect. Discounted payback period. Discounted payback period. Payback period you saw in traditional method. Here you are seeing payback period, but in discounted form. The biggest example for discounted payback period, can anybody tell me? Everybody knows that. There is an example, everybody life we will see that. Discounted payback period. This is a technical word, but there is everybody, I think every one of you, at least your family would have been involved in this. EMI. Discounted payback. It is EMI, car loan you take, EMI you will pay. Home loan you take, EMI you pay. Did you understand this one? Clear? You are giving out money, you are also giving out interest, you are also giving out the real value of the money. Did you understand this one? Okay. Next, modified internal rate of return. Same IRR, we will here see modified internal rate of return. Okay. This one is also first time. I think profitable index and MIRR is not in your foundation. This is first time that you are going to discuss here in, intern. Is this clear to you? Okay. Now let us understand payback period. I already told you what is payback period. You give some money, I get back that money without time value of money. Did you understand this? Clear? Look at the example. Steps. I am directly going to the steps. Steps in payback period technique. First step in calculating the payback period is determining the total initial capital cash outflow. Okay. Second step is estimating annual expected after cash flow. Okay. Two I told you. First there is uniform cash flow. There is non-uniform cash flow. Okay. Uniform cash flow. When the cash inflows are uniform like this, cash inflows are uniform over the useful life of the project, the number of years in the payback period can be calculated using the following equation. Payback period is equal to total initial capital investment divided by annual expected after tax net cash flow. Okay. Is it PAT or what is it? Can you tell me denominator quickly? Is it PAT? Is denominator PAT? Interest. Clear no? Same thing. PAT plus interest. Remember this one. We are doing financing now, not accounting now. So PAT plus interest in the denominator. For example, he gave example also. Look at this. Profit before tax is how much? 3 lakhs he got. Tax he removed 1,50,000. So he got PAT, for that he is adding depreciation back. So total cash inflow is how much? 4 lakhs. Okay. That should I take in numerator or denominator? 4 lakhs? Denominator. Clear no? I should take in denominator. What should be in the numerator? What is the initial investment? Okay, no? How much I'll get? 5 years. I'll get in the terms of years because this is a payback period. Okay, clear? Or I can find out 20 lakhs divided by 5 years. If I give my payback period, the person where I'm investing, if he says that I want returns in 5 years, I can also calculate how much cash inflows I need to have every year, per year, cash inflows. Okay. Okay. Don't go to the next page. Tell me, if I reciprocal this one, what will I get? There is a technical name for it, but I'm asking you, if I reciprocal 4 lakhs, what is this 4 lakhs? PAT plus interest divided by 20 lakhs. What am I getting? 1/5. What is this 1/5? Returns? Return on? That means you are saying 1/5 of the returns that you are getting, that you are invested per year. Define that. I want you to define what is this. What?
Payback period.
Payback period is 5 years. That I got. What is this?
That is accounting rate of
No, not accounting rate of interest.
So that is
No, I don't want technical term, but in your language, tell me what is this 1/5? What is the significance of that number 1/5 for me? What is the significance of that number 1/5 for me? What is the significance of that number 1/5? The significance is this. The amount that I invest. How much I am investing here? 20 lakhs. What part of that amount in a year I should pay? Did you understand? Again I am repeating. If I invest 20 lakhs, what part of that amount in a year I should pay? Is this clear to you? Okay. For example, somebody gave 1 crore rupees to me to do business, and he says that in every year 1/10 of the part you need to repay back. That means in a year how much I should repay back to him? 10 lakh rupees. Are you understanding this one? For that it will be useful for me. Is this clear to you? In parts I need to, but in what parts? That is what is called reciprocal of payback. Payback reciprocal we call it. What we call it? Payback reciprocal. That is what the next concept is. Okay. Non-uniform cash flows also he has given there. Annual cash inflows 80,000. Second year here non-uniform. It is not uniform. It is non-uniform. 80,000, 60,000, 60,000 and 20,000. Okay. Annual cash inflows. Cumulative I will calculate. Yes or no? Why I will calculate cumulative? to understand what did I get total after 4 years, to understand that. So 2,20,000 I got. So 2,20,000, what I am going to do now in the 4th year, look at this one, payback period shall lie between 3 to 4 years. Since up to 3 years a sum of 2 lakhs shall be recovered and balance is how much? 5,000 shall be recovered in the part of fraction of 4th year. Computation is as follows. You understood, no? Here it is not standard. I can either recover on 3rd year or either I can recover 4th year. Okay. Part of 4th year, balance cash outflow is how much? 5,000. Cumulative cash inflow of 4th year is how much? 20. So 1/4 year. Thus total cash outlay of 2 lakhs 5,000 shall be recovered in 1/4 years time. Okay. Did everybody understood? Yes, sir. Sure, pakka. Definitely understood this. What did he ask me? Suppose XYZ Limited is analyzing project of initial cash outflow 2 lakhs. Okay. 3rd year cumulative cash inflow is equal to cash inflow outflow. Hence payback period is 3 years. Okay. 2 lakhs 5,000. So since up to 3.5 years, 1/4 year I am doing. Okay. Now you understood why this 1/4 has come? Everybody sure? Pakka understood? Okay. Can you orally tell me without looking at book now? Up to 3 years we calculated? Clear no? Next. 4th year how much you got? 2,20,000. Now from here you tell me how I got that 1/4? 3 years are over. So the 3 years I'll keep aside. Can you tell me now why 1/4 has come?
In the 4th year, we got 20,000 cash flow. So we are assuming that
20,000 cash flow? Very good. Next.
is uniform, the 20,000 is uniformly throughout the year.
Yes.
So
Okay.
we require extra 5,000 to cover the initial.
Understood? No, extra 5,000 why? Again, why extra 5,000 I require?
Because initial outlay is 2,500,000.
Clear now? Everybody understood this one? Okay. So 5,000 is nothing but 1/4. So 3 years plus 1/4, 3/4 of the year. Did everybody understand this? Any doubt in this? Okay, now next. Advantages of payback period. That is what I told you. These payback periods, I told you in finance, nothing is nothing we call it perfect or imperfect. They have advantages, they have their own disadvantages. Okay, what are the advantages? It is easy to compute. What is there? Nothing is there in this. It's very, very easy to compute. Okay. It is easy to understand as it provides a quick estimate of the time needed for the organization to recoup their cash invested. Okay. Faster way I can find out that how much cash I require. Okay. Next. Length of the payback period can also serve as an estimate of project's risk. Okay. Can you tell me how? Simple here. Here only I'm asking you. How can I know project risk from this? How can I know project risk from this payback period? How can I know project risk from payback period?
Sir, by the time period, sir.
By the time?
Time period. So when we not able to receive money on the claim rate.
Understood. No? Because
The more the time rate, the more the
yes.
time, the more value will be losing.
Correct. For example, I'll tell you, somebody gave me money and said in 1 year you need to recover. Okay, clear, only 1 year they gave, but I saw my payback period is 5 years. There is a risk in this thing. Yes sir, that means I am getting slow inflow. For example, I'll give money, let us say we'll start a school now. Okay.
The period of
Some
inflows is long, sir.
Yeah, I'll say that when you will pay back, if I really calculate, I'll get school profits after 4 years, 5 years. Did you understand? That is a risk I'm taking now. Did you understand? If I don't get it 4 years and 5 years, what will happen? Understood this one? That clarity, where will I get? I'll get it payback period. Okay, clear? The longer the payback period, the riskier the project has. Long-term predictions are less reliable. Okay. In some industries, the high obsolescence risk, like software industry or in situation where an organization is short on cash, this part I will explain, this line I will explain. Short payback periods often become determining factor for investment. Did you understand that last 2 lines, which we did not cover, but it's a very good point. Did you see, why did he say software obsolescence? Why did he use word software obsolescence there?
Sir, because saving the time.
Obsolescence and he said software. Why? No, not because of that.
Time value of money decreases, sir.
Finance part understood, that you already told, because longer times it take, riskier for me.
No,
Very good. Technology will be updated. Why did he use the word software there? Because in some industries, what 1 year, 2 years I'll run, after 3rd year that project won't be there. It becomes a redundant project for me. Are you understanding this one? Now today if I start investing in cloud, tomorrow there is edge computing that is coming. 3-4 years after that edge computing again. So if my payback period is 5-6 years, I will not invest in it. Are you understanding what I am trying to say? Because I know after 3 years cloud computing won't be there. There is edge computing that is going to come. Is this clear to you? So I will not invest because my payback period is 5 years or 6 years. Is this clear to you? Okay, next. Limitations of payback period. It ignores the time value of money. The biggest limitation is what? Ignores the time value of money. That's why nobody follows right now. Okay, payback. The second limitation of this technique is its failure to consider investment's total profitability. Okay, total profitability. That is what profitability index is. See, each one we are seeing that profitability. First, time value of money is not there. That's why we brought discounted type of accounting. Clear? Next, after that we are seeing what now? He is saying profitability is not considered. That's why we got profitability index in the next coming this thing. It only considers the cash inflows up to the period in which initial investment is fully recovered and ignore cash flow after the payback period. Is this clear to everybody? It is not that I invested 20 lakhs, you gave me back 20 lakhs. I will not say that, okay, I am out of the project. Will I do that? You invested in somebody's, for example, you invested in a company hoping that this company will keep giving me money back. Okay, you invested 20 lakhs and company says, I paid back your 20 lakhs, please go out of the company. Will you do that? Okay, I invest in some company, what I'll expect, I'll keep expecting that money keeps coming for me lifelong. Understood? That's for that only you take equity, no? From him, what do you take? You take equity. So payback, can I apply equity concept in payback? I cannot apply because you're giving back, after that you're not saying how much profits you're going to get. Did you understand this? Is this clear to you? Okay, next. Payback techniques places much emphasis on short payback periods, thereby ignoring long-term projects. Okay, it will only see the short-term paybacks. It will not see long-term paybacks. What do you mean by that? Sir, if I do paybacks, I get 10 years also, no? Why are you saying it is only short-term, not long-term? Why that question he said, it will only see short-term, it will not see long-term?
Whichever payback is lower, people will choose that. But if the
understood, no? 2 years payback I'll go show interest in that one. 5 years payback, I will not show interest because it's a long time one. And after 2 years, what will happen? You can stay in the company still, but it is not that you got payback, you got money back and they'll send you out. It is not like that, no? You are out of the investment, it is not like that. Isn't it clear? So payback money is only considering what? Short term. It is not considering long term. Okay, some projects long term. For example, people are investing in Swiggy. Why are they investing in Swiggy, Oyo? From how many years it is producing losses? Yes or no? It is a long term. If I go with payback method, I will never invest in Swiggy because still 5 years it did not give a single cash flow to the shareholders. Dividend 1 single rupee also did not pay. Did you understand? But people are seeing at the long term view. Okay, that's why they did not apply this payback principle in that. Okay, long term view. Tomorrow people will get used to home deliveries of food. That time this company may become a bigger company. So they are looking at long term. They are not looking at the short term. Okay, there is an important saying also in strategical financial management. They say that generally people who are rich with cash, they look for long term projects. People who are less with cash, they look for short term projects. Did you understand this one? I have more cash, more payback period I look for. I have less cash, less payback period I look for. Is this clear to you? Okay, next. Payback reciprocal. I already explained you what is payback reciprocal. What is payback reciprocal? Average annual cash inflow divided by initial investment. Okay, look at the example there. Suppose a project requires an initial investment of 20,000 and it would give annual cash flow of 4,000. Useful life of the project is estimated to be 10 years. In the example, payback reciprocal is how much? 20%. That means per year I will pay 20% of the amount. Every year I will pay how much? 20% of the amount. I will pay back the 20% of the amount to him. Is this clear to you? That is how you need to understand this 20%. Clear? Payback? Okay, payback is simple. Next, accounting book rate of return. Accounting rate of return, ARR, is nothing but average annual net income divided by investment. I told you in the beginning, cash flows need not be same. It can be different each period. But in ARR, what will I do? I will take average of them, not like payback period. I will consider each how much I got, each year how much I got. What will I do? I will take average. So whether it is constant or not constant, I will take average annual net income divided by investment. Did you understand this one? Clear? That is accounting rate of return. Okay. Now, example. Suppose Times Limited is going to invest in a project, a sum of 3 lakhs having a lifespan of 3 years. Salvage value of machine is also given. Profit before depreciation for each year is 1,50,000. The profit after tax and value investment in the beginning and the end of the tech. Okay, clear. Look at this. First year, profit before depreciation 1,50,000. Depreciation is there. Same again. Profit after depreciation is how much? 80,000. Okay. Now value of the investment in the beginning is 3 lakhs. End is 2,30,000. Okay, because I am adding that profit after depreciation 80,000. Okay, clear no with this? Done, understood everybody? Now profit before depreciation here also. Value of the investment in the beginning is 2,30,000, in is 1,60,000. Okay, you understood that table? Question you understood? Now version 1. On the annual basis, if I have to calculate, ARR is equal to profit after depreciation divided by investment in the beginning of the year. Three ways you can do. He is showing all the 3 ways. Version 1. Okay. Profit after depreciation is how much? 80,000. Profit after depreciation is 80,000 divided by investment in the beginning is how much? 3 lakhs. Okay. Percentage you got. Same way in the second one also. Depreciation 80,000. Profit after depreciation 80,000. Investment in the beginning is 2,30,000. Same. So it is same like on each investment how much profit I got. Yes or no? Are you understanding on each investment how much profit I got? Okay. Now average ARR, how many years it is? 3 years. Either I can calculate it like that, or you can see the next version. Average annual profit I'll take. Every year I'm getting consistently 80,000 divided by 3, whole divided by what is the initial one? 3 lakhs. That I can do. Next version 3. Average investment basis. Average annual profit I will take. That is 3 lakhs plus 90,000. Now average investment is initial investment minus salvage value. Okay. And what I will do, I'll add in the end that average I took. After that I'll add in the end the salvage value. So ARR is 80,000 divided by 1,95,000 into 100. That is 41.03%. Any doubt in this? Clear no? 3 versions you understood? Okay, simple. These are with examples easily you will understand. Okay. Further, it is important to note that project may also require additional working capital. Now, it is not that initial end. We are only looking at these two. What happens if I require a working capital in between? Yes or no? Clear? That what I need to do, I need to add in the end. The salvage value I am adding, that working capital also I need to add in the end. Is this clear to you? Okay, additional working capital I need to add in the end. Now, advantages of ARR. This technique uses readily available data that is routinely generated for financial reports. Yes or no? Clear? Again, this technique uses readily available data that is routinely generated for the financial reports. Okay. Can you tell me opposite of this one? It can be a disadvantage also for this. Advantage is saying this technique uses readily available data. That means for a startup and all where the data is not available, can I calculate ARR? Understood this one? Clear? Next. This method may also mirror the method of evaluate performance on the operating results of an investment and management performance. Did you understand? ARR will give me a basic brief of performance. Okay, clear? Next. Calculation of accounting rate. Return method considers all net incomes over the entire life of the project. Considers all net incomes over the entire life of the project. Okay, limitations. Again, ignores time value of money. I told you in traditional method, the biggest limitation is what? It ignores time value of money. Okay. Technique uses accounting numbers that are dependent on the organization's choice of accounting procedures. Okay, each one will have different accounting procedures. Next one. Method ignores cash flows. Because we are taking averages, we are not taking all the cash flows. Okay. Furthermore, inclusion of only book value of the invested asset ignores the fact that project can require commitments of working capital and other outlays that are not included in the book value of the project. Okay, no? Understood this one? For that he gave another example also. Okay, same here. Version 2 and version 1 and version 2 he has used. Total profit divided by number of years. Average investment divided by initial investment. Average investment divided by initial investment. Just go through that example once. Year 1 profit, directly he gave profit after tax and depreciation. So you need not calculate anything. Plant and machinery project can be sold at 80,000 is saying. Okay, first one is initial investment is considered. Next one is average investment is considered. Clear, no?
Yes, sir.
Okay, no?
Sir, I will have to salvage value of that.
Why we are having?
Adding salvage value for average investment calculation.
Here you are saying or in the previous one? See, if you see in the version 2, in the previous one, you can go to the example version 2. In the version 2, version 3, if you see, what are we doing there? Average investment basis, what are we doing? Average annual profit we are taking, divided by average investment. Okay, clear? Now, average investment is what? What is my average investment? Initial investment minus salvage value. Okay, for every year I'll take, that average I'll take. Okay, what I'm doing, again I'm adding salvage value because I'm selling off that, no? So I'll add that salvage value. Next, working capital I will add. These three things I will add. Is this clear? Okay with that example? Okay. Now, generally if you ask me, payback period and ARR, generally ARR is not that interesting as a topic. But discounting values are very interesting, and that is what modern finance also applies. Okay. In discounting, I told you NPV and these things are there. I'm not going to discuss it now, but I'm telling you. Okay. Now briefly look at this one. From beginning of this, what did we do? It was more theoretical. Yes or no? For each one cash inflow, why did we see that example? Outflow, why there is an example. Clear? Payback period, there is an example. Okay. ARR, again he has given an example. Okay. Capital budgeting is a chapter where you will understand the logic only when you go by examples. Is this clear? Okay. In the previous chapters, it was not like that. We can understand even the example is not there easily because, for example, you take capital structure. Why we need to have this capital structure? Cost of capital. Why the cost of capital? Because we put it in the formula and see what is the cost of capital. Here it is not like that. Did you understand this one? You understand the theory, you should be able to apply it in the example immediately. Okay. Clear? In the next class, what we will do is, now we NPV, IRR, I will discuss all these things. I will briefly tell you all the formulas. We will not go like this one by one because this theoretical part is over. Next part is a practical part where mathematics is more involved. I will tell you what is NPV, what is IRR, how do we calculate in different situations, what you will add and what you will remove. Okay. Once we do that one, we will take each example. We will take each example and calculate everything that, even if your book is not given, it asked only to calculate through NPV. We will see other things also. How do we calculate? If not NPV, how do we calculate using payback? Okay, like that you will get an idea. So it will be a recollection for you. It will be a revision for you. If you don't revise this one, these theoretical things you will forget it very easily. Okay, because capital budgeting is all about procedures. What procedures that you are going to apply. Okay, briefly, what did we do? First, depreciation and interest is a cash inflow we identified. We did that one. Okay. Next, we did traditional method. In traditional method, what did we do? We did payback period and reciprocal of payback period we did. Next we did ARR. In ARR what did we do? We did investment, initial investment method we did average investment method we applied. Is this clear to you? Version 1 and version 2 we applied. Okay. In the next part of the next class we will see NPV with continuous cash flow, that means constant cash flow, and which are not constant. Okay. We will see IRR, after that we will see MIRR. After that, we will see profitability index and these things. Okay. While applying in the question, I suggest you go through all these examples, try applying different methods to it and see what differences are you getting in this and in that while you are capital budgeting. Is this clear to you? Okay. Or else you will feel that first part of capital budgeting being very bored. Okay. Clear? It will be boring because all the procedures will tell you apply this rule, this rule, this rule, this rule, this rule. Because there is no logic, he will keep telling you rule. You will understand logic only when you apply that practically. This is clear to you? Okay, that's it.